In September 2008, the world watched something that wasn't supposed to be possible. A legendary Wall Street institution, a 158-year-old titan, collapsed in front of everyone's eyes. Lehman Brothers filed for bankruptcy, and $600 billion evaporated overnight. Markets froze, credit died, banks panicked, and millions of people walked into work the next day not knowing they'd be unemployed by the end of the month. But here's the truth no politician, no banker, no economist wants to admit. The collapse didn't begin that day. It didn't even begin that year. It started with a lie, so dumb and so seductive you could print it on a billboard and people would clap while falling for it. Why rent when you can own? Go back to the early 2000s. The United States was limping after the dot-com crash. Trillions in market value had been burned to ashes. And then 9/11 happened, punching the entire economy in the throat. Wall Street was anxious. Investors were numb. Businesses were terrified. So the Federal Reserve came up with a solution that felt brilliant at the time and catastrophic in hindsight. Cut interest rates to the floor. Suddenly, borrowing money was as easy as breathing. Loans were practically free. And in a country addicted to optimism and home ownership, that was all it took for real estate to turn from shelter into a national betting arena. Mortgage brokers transformed into overexcited game show hosts. Congratulations! You're approved for $500,000. But my income's only $40,000 a year. Irrelevant. Adjustable rate mortgage, balloon payment. Don't read the fine print, just sign right here. It didn't matter who you were. Good credit, bad credit, no credit. A stable job, no job, 3 jobs. Banks had a new philosophy. If you have a pulse, you get a mortgage. And if your pulse is weak, we'll throw in another loan to help you relax. This is how subprime mortgages exploded. Subprime, a fancy Wall Street word for absolute financial garbage. These were loans built for people who had never managed money responsibly in their life. People who defaulted on phone bills, who missed rent payments, who lived paycheck to paycheck. Yet suddenly, these same people were buying homes worth hundreds of thousands of dollars. Homes they could never afford. Homes they barely understood. Homes that bankers claimed would make them rich. The entire housing market turned into a circus. A teacher earning $45,000 a year could buy 2 condos by filling out a few forms. A barista working part-time could get approved for a beachfront apartment. A guy living in his mother's basement could walk into a bank wearing a hoodie and leave with the keys to a house he'd never even visited. People weren't buying because they needed a roof. They were buying because they were convinced housing prices were a staircase that only went up. But behind the scenes, lenders weren't just bending the rules. They threw the rulebook into a shredder. Income verification? Optional. Down payments? A cute relic of the past. Debt-to-income ratio? Boring. Risk assessment? Slows us down. Mortgage brokers were making so many commissions that they stopped viewing clients as people. They viewed them as bonus checks walking on 2 legs. And then something even more insane happened. People started buying homes they didn't want to live in. They bought homes just to flip them, to treat real estate like lottery tickets. Everyone became a self-proclaimed investor. I just bought my 3rd house this year. I don't even live in any of them. My bank just approved me for another penthouse in Miami. This wasn't investing. It was collective delusion. Housing wasn't an economy. It was a mania. Meanwhile, deep inside the towers of Wall Street, a different beast was growing. You see, these banks had a problem. They were giving loans to people who obviously weren't going to pay them back. But banks had figured out a trick so profitable, it might as well have been a cheat code printed directly into capitalism. They didn't need the loans to be good. They just needed to bundle them. Thousands of subprime mortgages, mixed with a handful of decent ones to make the smell slightly less awful, were packaged into giant financial products called mortgage-backed securities. And if that wasn't convoluted enough, those securities were repackaged again into even more complex structures called collateralized debt obligations. With every remix, the original toxic loans were pushed deeper inside, like hiding rotten food inside a shiny gift box. But there was one final piece needed to sell this garbage to pension funds, insurance companies, and investors around the world. The blessing of the ratings agencies. Moody's, Standard & Poor's, Fitch, the financial holy trinity. Their job was supposed to be protecting investors, evaluating risk, being the adult in the room. Instead, They behaved like paid actors in a commercial for poisoned candy. Banks paid them billions to stamp these toxic bundles with the highest, safest, squeakiest clean rating possible. AAA. Imagine taking a dumpster full of spoiled meat, spraying it with perfume, and calling it prime steak. That was the rating system. And investors around the world bought it, because the ratings agencies told them it was safe. But here's where the story takes a darker, more twisted turn. A few investors, skeptical misfits with too much curiosity, decided to actually open the hood and look inside these mortgage bundles. And what they found was horrifying. Loans with missing documents. Loans signed by people who had no income. Mortgages approved for applicants whose handwriting looked like they filled out the form while falling down a flight of stairs. The entire foundation was rotten. These investors asked a brilliant question. What if we bet against all of this? At first, Wall Street laughed in their faces. You want to bet against the housing market? Adorable. But once bankers realized they could make money off that too, they changed their tune. So they created something new, something experimental, something that would later detonate the global economy. The credit default swap. A credit default swap is basically insurance that pays out if a mortgage or mortgage bundle collapses. But the insane part is that you didn't need to own the mortgage to insure it. You could simply say, hey, I think this is going to explode, and the bank would happily sell you a policy. Buying a credit default swap was like buying life insurance on your neighbor's grandmother, and then cheering every time she slipped on a wet staircase. And once the door opened, everyone rushed in. Hedge funds, investment banks, traders. They all made bets on loans they didn't own, didn't control, and didn't care about. Bets stacked on other bets, insurance on insurance, derivatives built on derivatives. A financial Jenga tower built by people who were convinced gravity didn't apply to them. By 2006, the U.S. housing market was a giant, glowing bomb. And everyone, banks, investors, homeowners, the government, pretended not to hear the ticking. And then, in 2007, the bomb finally started to crack. At first, it was small things. A missed mortgage payment here, a foreclosure notice there. A condo in Las Vegas sitting vacant for months. A house in Florida listed at half its appraised value. The kind of signals that experts should have noticed instantly, but ignored, because acknowledging reality meant acknowledging the end of the party. But soon the cracks turned into fractures, and those fractures turned into a landslide. Housing prices stopped rising. And in a system built entirely on the belief that they must always go up, that was catastrophic. Those subprime borrowers who were barely scraping by suddenly saw their adjustable interest rates spike. Monthly payments doubled. Some tripled. People who were struggling at $800 a month now owed $2,400. Over 1 million homeowners instantly found themselves drowning. Defaults surged like a tsunami hitting the coast. And remember those mortgage-backed securities that were supposedly safe? Those AAA-rated bundles were now collapsing from the inside. Investors who thought they owned gold realized they were holding nuclear waste. Pension funds, insurance companies, hedge funds, everyone was exposed. And the contagion spread through the financial system faster than anyone could stop it. Banks that had filled their balance sheets with these safe assets suddenly realized they were holding billions in worthless paper. Accounting departments scrambled. Traders panicked. CEOs held emergency meetings at 3 a.m. The numbers didn't make sense. The losses didn't make sense. The risk models didn't make sense. Everything they believed about the housing market was wrong. And then came the breaking point. Lehman Brothers. One of the oldest, largest, most respected banks in America. Gone. No bailout, no rescue, no lifeline. Just a historic, catastrophic bankruptcy. The moment Lehman fell, global trust evaporated. If Lehman could die, anyone could. The financial system relies on faith, and in that moment, faith died instantly. Interbank lending froze. Banks refused to lend to each other because they didn't know who was lying and who was next to collapse. Companies couldn't pay their employees. Consumers couldn't get loans. Investors couldn't withdraw money. ATMs ran low on cash in some cities. The entire global financial system seized like an engine running without oil. People watched their retirement accounts shrink in real time. Years of savings gone in hours. Families that had done everything right suddenly owed more on their homes than the homes were worth. Foreclosures skyrocketed. Neighborhoods turned into ghost towns. Moving vans lined the streets like funeral processions. This wasn't just a financial crisis. It was a humanitarian crisis disguised as an economic one. And the shockwaves didn't stop at America's borders. Europe staggered. Iceland's entire banking system collapsed. Japan's markets plummeted. Brazil, India, China, everyone felt the impact. Global economies are connected by invisible threads, and in 2008, all those threads snapped at once. The United States government faced an impossible choice. Let the entire financial system collapse, or save the very institutions that created the crisis through greed and fraud. They chose the second option. And just like that, the era of free markets evaporated. Suddenly, capitalism came with airbags. The government unleashed the largest bailout in modern history, the Troubled Asset Relief Program, TARP. $700 billion. Bailouts for banks. Bailouts for insurance companies. Bailouts for failing automakers. AIG, the company that gambled trillions on toxic swaps, got $180 billion alone. To save the system, the government essentially nationalized parts of the financial sector. Meanwhile, the Federal Reserve launched unprecedented measures. Interest rates were slashed to zero again. The Fed began printing money through a process called quantitative easing, a polite term for injecting trillions of dollars into the economy to keep it from collapsing. The Fed started buying government bonds and mortgage-backed securities, trying to stabilize markets with sheer force. And while Wall Street received unlimited oxygen, Main Street was left gasping. 8 million jobs vanished. 4 million homes were lost to foreclosure. $19 trillion in household wealth evaporated. Families who had spent decades building stability were thrown into chaos. Homelessness rose. Soup kitchens overflowed. Unemployment offices looked like disaster relief camps. The people who caused the crisis walked away with bonuses. The people who suffered through it got pink slips and eviction notices. And the outrage that followed was volcanic. In 2011, thousands gathered in Zuccotti Park in New York City. Occupy Wall Street was born. Tents, drums, homemade signs reading, "We are the 99%. People weren't just angry about the crisis. They were angry about the system that allowed the crisis. They were angry that profits are private, but losses get socialized. They were angry that no major Wall Street executive went to jail. Not one. Fraud on a global scale, and nobody paid the price. But here's the final twist. The system didn't collapse in 2008. It rebooted. It reset. And in many ways, it came back stronger for the people who built the bomb in the first place. Banks got bigger. Regulations got weaker. Housing became more unaffordable. And the same toxic incentives that created the crisis never disappeared. They just changed shape. The machine kept running, rebuilt by people who never learned a lesson because they never felt the consequences. And that's the real story of the 2008 financial crisis. A crisis born from cheap money, reckless lending, corrupt rateness, gigantic leverage, and blind faith. A system propped up by illusions until those illusions shattered. A collapse that scarred a generation and reshaped the global economy. And the darkest truth of all, the next crisis won't look like the last one. It will look safe. It will look profitable. It will look inevitable. Until the moment it detonates. Because once you understand how 2008 happened, there's only one conclusion left. The system didn't fail. It worked exactly as designed. And that's why it will fail again. A credit default swap is basically insurance that pays out if a mortgage or mortgage bundle collapses. But the insane part is that you didn't need to own the mortgage to insure it. You could simply say, "Hey, I think this is going to explode," and the bank would happily sell you a policy. Buying a credit default swap was like buying life insurance on your neighbor's grandmother and then cheering every time she slipped on a wet staircase. And once the door opened, everyone rushed in. Hedge funds, investment banks, traders. They all made bets on loans they didn't own, didn't control, and didn't care about. Bets stacked on other bets, insurance on insurance, derivatives built on derivatives. A financial Jenga tower built by people who were convinced gravity didn't apply to them. By 2006, the U.S. housing market was a giant, glowing bomb. And everyone, banks, investors, homeowners, the government, pretended not to hear the ticking.